My name is Dave Wilhelm. I'm a professor at Wake Technical Community College in Raleigh, North Carolina. I teach business courses, some seated, some online. This video is one in a series to ensure that my online students get roughly the same information as my seated students. The topic on this video is ratio analysis, specifically financial ratio analysis. We'll look at the types of ratios, ways they can be used for comparisons, brief look at financial statements, which is where we'll be getting the information for the ratios, and some examples. There are 5 types of ratios, at least that's one way of dividing them. They're liquidity ratios, which basically is how fast can you get a hold of liquid assets to pay your debts. There's a current, a quick, and a cash ratio. There are activity ratios, looking at how fast your inventory turns over, how fast you collect your accounts receivable, looks at sales over assets. Leverage ratios basically look at borrowed money. There are debt ratios and interest ratios. Profitability basically compares net earnings or earnings after taxes to everything else. Market value ratios, these are not the internal ratios that are used for management decisions, but external ratios that are interesting to investors out there. There are at least 3 ways to use these ratios. We can compare them among organizations. That is, we can look at another organization similar to ours, look at these ratios, and make a judgment whether we're doing better or worse in various areas. We can do a time series where we look at our own organization's performance over a period of time to see how it's changing. And there are standards. Most industries have a trade group, and most trade groups have a magazine, and many of those publish typical ratios for that industry, maybe 75, 50, 25 percentiles, some way to let the businesses in their industry know how they're doing, where they're doing well, where they may need improvement. Here is a very brief earnings statement and balance sheet. For the ratios, we will be using numbers from the earnings statement and from the balance sheet. We will not be using any from the cash flow statement, though I'm sure there are ratios using the cash flow statement. So we have, on the earnings statement, we have net revenue, subtract cost of goods sold to get gross profit, subtract operating expenses to get the operating profit. If you're looking from the top down, we call it operating profit. If you're looking from the bottom up, we call it earnings before interest and taxes, because right after this operating profit or earnings before interest and taxes, we subtract the interest expense to get pre-tax profit. And after that, we subtract the income tax to get net profit or earnings after taxes. And one last thing is to distribute some of the earnings to the owners. Net profit, earnings after taxes minus dividend distribution is what goes to the owner's equity contribution. The assets, current and fixed. Current includes cash, accounts receivable, and inventory. Fixed, land, building, and equipment. And add all those together and you get the total assets. On the liability side, we have current and long-term liabilities, which pretty much match the assets. Current, we have accounts payable and the current share of the long-term liabilities. That is, there may be a portion of the long-term liabilities that we have to pay this year. That will show up in the current or short-term liabilities. Long-term, we might have a mortgage, we might have a loan. And add those together and you get the total liabilities. The owner's equity account, the owner contribution, this could be a sole proprietorship where the owner puts money in, a partnership, a C corporation, an S corporation, somehow how the owners have invested their money to own a portion of the company. And then retained earnings, the cumulative earnings over the years that are left after the dividend distribution. So those are the retained earnings as opposed to the distributed earnings. Here are the same earnings statement and balance sheet information, except now it has numbers attached. And we'll use these numbers in calculating the ratios. Besides the information that shows up on the earnings statement and balance sheet, some notes are interesting. One, all earnings statement and balance sheet numbers are in thousands. So when this says net revenue is $370,000, it really means $370 million. Shares of stock outstanding is 10 million. The stock price is $37. And a depreciation of 5,000, that is to say 5 million, is included in operating expenses. A reminder, earnings statement and income statement and profit and loss statement all refer to what I refer to as the earnings statement. Net profit is the same as net income or net earnings or earnings after taxes. It's the last value before we distribute some of the earnings to the owners. Here are the liquidity ratios. Cash ratio compares how much cash is on hand to the current liabilities. Quick ratio takes out the inventory, so it compares the cash plus the accounts receivable to the current liabilities. And the current ratio compares all of the current assets to all of the current liabilities. To calculate that, we need the current assets and the current liabilities. With that information, we can calculate the current ratio. Current assets, remember they're $43,000. Current liabilities are $8,000. 43,000 divided by 8,000. As long as we're taking a ratio, we can leave off those extra 3 zeros because they're going to drop out. And generally I drop them off. Just 5.375. And dollars are really in thousands, but as long as it's a ratio, we can't ignore them. So the current ratio is about 5.4. Is that a good value or not? One wants enough cash, one wants enough current assets to cover the current liabilities if you have to, but one doesn't want too much tied up in cash because there are probably better ways to invest it. Activity ratios, a couple inventory activity ratios are inventory turnover, how many times the inventory turns over in a year. I find the days of inventory a little more intuitive to understand, and that's just inventory divided by the cost of goods sold per day. Inventory is $20,000, so we've got $20,000 of inventory. How much are we using each day? And that will be the cost of goods sold, only converted from an annual amount to a daily amount. Inventory was $20,000. Cost of goods sold was $250,000, but we need to spread that out over 365 days. So 20,000 divided by 685, and that says that on the average that material in inventory has been there for 29.2 days. Is that good or bad? It depends on the industry. Another activity ratio is receivables. How fast are we collecting what people owe us? We have the turnover, which is similar to the inventory turnover, and then we have the average collection period, which is, for me, is just more intuitive. It makes more sense. For the average collection period, we need net revenue, and we need accounts receivable. And if we look at the accounts receivable divided by the average daily sales, that'll tell us how many days of collectibles are sitting around. 370,000, that's the sales, but we need to spread it out over 365 days, which gives us a little over $1,000 of sales per day, or 7.9 days is how long the average account receivable has been sitting there. Some other activity ratios. Most are comparing sales to one term or another. Fixed asset turnover compares sales to fixed assets. Total asset turnover compares sales to total assets. And sales to inventory compares them to inventory. Some debt leverage ratios looks at basically how much do we own of the company compared to what we owe to creditors. And you can look at total debt to stockholders' equity. You can just look at long-term debt to stockholders' equity, or you can look at debt to assets. Total debt to total assets ratio in particular, generally total is understood unless some other qualifier is there. And we just want to look at the total debt to the total assets. For that, total debt, right here, 23,000 million really. Total assets, 68,000 millions really. And we divide that total debt by the total assets. 23,000 divided by 68,000, or 0.338, about 34%. And what this means is that of all our assets, somebody else really owns 34% of them. 66% is ours, and 34% in effect is owed to some other parties. Another interesting leverage ratio is, can we cover our interest payments? Banks and other people who loan us money want two things. They want to get the money back someday, and they would also like to be paid for the use of that money. And it's interesting to see how close we are to covering that. In this case, cash coverage looks at earnings before interest and taxes and adds depreciation. Depreciation is a non-cash expense, so it does make sense to add the depreciation in. For our purposes, let's just use times interest earned. Earnings before interest and taxes divided by the interest expense. So we want that to be at least 1. Earnings before interest and taxes is also sales minus cost of goods and minus operating expense, also called operating income. We will need the operating income or earnings before interest and taxes and the interest expense. Just intuitively here, we got 49,000 of earnings before interest and taxes and 12,000 of interest expense, so we're looking pretty good. Nevertheless, let's do the arithmetic. There's our 49,000 of earnings before interest and taxes, 12,000 interest, so we have it covered 4.1 times. That's probably a very good thing. We're not on the edge or anything. Earnings to sales, profitability ratio. Gross profit margin, that's taking away the cost of goods sold. Also take away the operating expense, and we've got earnings before interest and taxes compared to sales. And if we go right down to the net income or earnings after taxes, we can get the net profit margin ratio. And once again, we're comparing a whole lot of things to sales. How much expense is each thing compared to sales and what's left over afterwards. And let's look at the net profit margin ratio. We need net income and we need sales. And we can find the net income or net earnings down here, the net revenue up there. And if we put them together like this, net income over sales, $25,000 of net income divided by $370,000 of sales gives us 0.068 or about 6.8%. Some other profitability ratios: return on assets, net profit after taxes over total assets; earnings per share, net profit after taxes divided by the number of shares; and return on equity, net profit after taxes divided by owner's equity. And this is kind of the return on investment in one way. Return on equity, we're going to need the net earnings down here, earnings after taxes, and the total owner's equity. The net earnings, 25,000, the owner's equity, 45,000. Do the math, it comes out to 0.56. Comes out to 0.56, or about 56%. That's a pretty good return. The final category of ratios is market financial performance ratios. These are what people who follow the stock market key on. Common stock, dividend yield, dividend divided by market price; market to book ratio, dividend payout ratio; and price to earnings ratio. And we'll do the calculation of price to earnings ratio, where we would like to know the market price per share and divide that by earnings per share. Now, the market price and the number of shares are not on the balance sheet or the earnings statement. Those values were in that extra sheet of information. We do start off with the net earnings, though. And remember, it's market price per share over earnings per share. Market price per share, we know that it's $37 a share. To get the earnings per share, we have to divide the total earnings by the number of shares outstanding. And in this case, we need to include the extra 3 zeros from the earnings statement because we're dividing it by an outside number, not just a ratio. So 25 million divided by 10 million is $2.50. Earnings per share, divide that into $37 and you get 14.8. Investors pay a lot of attention to this. One way of looking at it is to turn it upside down and look at the earnings to price ratio, and in this case it's 0.068 or 6.8%. That is kind of the value of the return you're going to get if you buy the stock. That's it. That's plenty. There are lots of other ratios. Nobody needs to know all these ratios. Depending on what your responsibilities are in a job, you probably need to know a few of them. You will key your management methods, all these values. You can compare them to what you did last month, other companies to the standards. That's it on ratios. My name's Wilhelm. If you have any questions or comments, feel free to email me.